Yeah, we've had a couple questions come in on Nuvei again. We've done a couple previous segments, like we said, and it's been in the spotlight again. So it's a good time to look at it. Nuvei Corp, if you're unaware, is a provider of payment technology solutions to merchants and partners. The solutions provided are mobile payments, online payments, and in-store payments. The stock currently trades under the symbol NVEI at roughly 22 Canadian on the TSX and 1631 US on the NASDAQ. It is roughly down 37% year to date, and that's down 87% from its pandemic high. When I last did a segment on Nuvei in March, the stock was about $56, so it's dropped roughly 60% since then. So really, what has changed? So leading up to our initial talk on Nuvei at the start of the year, reported its Q4 and fiscal 22 earnings, which caused the shares to jump. But since then, it has two major overnight declines following both the Q1 and Q2 earnings. Q2 caused the stock to fall about roughly 40% overnight last week. Just by looking at the price and nothing else, we can really assume the market was just unimpressed by the earnings. Of course, we want to look into the reason because the market can overreact or unreact to certain metrics or just overlook or really rely on something which they shouldn't. As well as just a bit of an aside, Ryan Reynolds' promotion of the company took place in April, which just shows you can't jump into a stock because a promoter says you should. So, looking at the Q2 earnings, which were reported last week, total payment transactions increased by 68%, but only 23% of that was organic as the company conducted its acquisition of Paya earlier this year. The transaction volume increase led to increased revenue of 45% to $307 million, of which 20% of that was organic and wasn't related to cryptocurrencies. However, GAAP net income fell substantially to $11.6 million from $35.1 million last year, and non-GAAP income, which notably removes share compensation and acquisition-related expenses, still fell 22% to $58.1 million from $74.7 million. As well, adjusted EBITDA did, however, increase by 19% to $110.3 million. However, as the company took on significant debt with this acquisition of Paya, it went from interest income to significant interest expense, which of course is removed from EBITDA, which is why you have EBITDA growth while net income shrunk. So year over year, EBITDA growth, I should say, isn't really a quality metric in this case, as it has had a structural debt change where you realize much of the benefits by acquiring Paya, you get that operating income, but you don't really realize the associated financial costs, which isn't included in EBITDA. So it doesn't really create a strong picture of understanding that company's actual operation, which is the main selling point of EBITDA. Going forward, it will be better as the structure obviously isn't changing substantially quarter over quarter. It's just this one-time shift. You can't really look at just this growth and say, oh, it's growing 19%. There's a lot more that goes into it. So overall, the quarter just really was not great with growing revenue, which is expected at the current valuations, but shrinking income is ultimately what matters because you're relying on the bottom line at the end of the day, not just the top line growth. However, moving to the guidance, the company has lowered expectations across the board, stating that their previous growth expectations were just too aggressive and that implementation will take time. As well, they lost a large customer during the quarter. The result is revenue growth is now expected to be between 16 and 20% for fiscal 2023. The resulting adjusted EBITDA was lowered to $417 million to $432 million. Previously, it was $456 to $477. So that's a 9% drop in their guidance between the two quarters. That is concerning when the company's valuation is almost purely relying on growth at this time. The company does have long-term targets of 15 to 20% annual revenue growth and 50% adjusted EBITDA margin, but is just well off of that at this time. It's at about 36%. So if they are able to hit those margin expansions specifically, that could be of nice value add, but this latest guidance decrease really puts that target into question in the long term even. So a quick look at valuations. The company's GAAP PE is an absurd 122 times, making it effectively meaningless. Non-GAAP PE, trailing PE is much more reasonable at 9 times. Remember, that removes significant costs from the share compensation as well as the restructuring. And I will add, they have an outstanding NCIB actively buying back shares, which is a bit of a personal pet peeve of mine, which I mentioned, I know Brendan about a dozen times. When they remove the share comp, but then they're buying back shares, it's really just the same as paying higher salaries, which wouldn't be removed in this case, but I really digress. And lastly, adjusted EV/EBITDA is 9 times on a trailing basis, and off their midpoint outlook for the year, it's about 8 times. significantly lower than when we last looked, but it's still not overtly cheap. So concluding, debt is still a concern, although they are paying it down, but it needs to be actively watched, incorporated into the valuation. That's why EV/EBITDA is a better metric in this case compared to just PE. The decreased growth expectations are what routed the market, disillusioning many investors who were relying on high growth and it being a high growth story. So you need to watch that. Is growth just going to disappear at this point? Is it going to pick back up? That's really the question the market has. And as well, Ryan Reynolds may be a great actor in my opinion, but that does not mean he's a great investor. Don't follow celebrity investing advice or paid promoters in general, as even Brendan last week with Vigano. And for now, I would just stay away from the stock if the management is able to start hitting or at least moving towards its long-term target margin and while keeping it out up at about 20 to 25% growth for the short term, then they're 15 to 20% in the long term. The valuation could be more reasonable, but right now it's just far off what you need to be investable when the management can't hit their own guidance. So I'll open up to you guys if you had any comments.
Yeah, I mean, I would say love Deadpool. Can't wait till the next Deadpool comes out. But I'm probably not taking. I love Ryan Reynolds, really, Vancouver icon. To be honest, please buy the Vancouver Canucks. That would be awesome if you could do that. But not taking the advice on in this specific situation on Nuvei. And we said that earlier in the year at other valuations. So not just, at this point, we've been saying that for quite a while. Not that it's the worst company out there. It's just the valuations don't meet our criteria. And I think the point you made on the capital structure of the business is so different now from where it was year over year. And you look at adjusted EBITDA increasing, but they were in a net cash position at that point versus a significant net debt position now. So you look at EBITDA, well, that's why you have EBITDA up 19%, but net income is down significantly because the interest expense wasn't even there. So it's just sometimes, comparing that year over year or comparing that in a business, EBITDA often isn't a great thing to look at, and it's better to just look at cash flow because that's an actual expense. They have to pay their income, right? So they have to pay their interest. Sorry. So removing that is,
they initiated a dividend, which that's a little weird to me too. I think going forward, the yield's 1.8%. For a growth company.
What is the yield? Sorry, what did you say?
I think it's 1.8% going forward. I'm pretty sure. Because
I think it went up.
Because it was 10 cents that they're doing. So I mean, just times that by 4.
2.5% or so.
Oh, okay, it's 2.5.
Yeah, it went up because the stock has probably dropped since you looked at it.
Has gone down. That's why, right? Yeah.
Yes.
That's the issue.
So I just find it weird, a high growth name is all of a sudden, paying a dividend. Not that we like dividends, obviously, but
also that the significant leverage position. Perhaps it's just better to pay off the debt at this point. Exactly. And if it's been a growth a position for growth business, it's we don't mind. I haven't looked into the dividend policy. Maybe it is based off of a certain amount of cash flow, and maybe the plan is to grow that dividend over time. But often, when we're advising some smaller companies, they'll ask us, do you think we should pay a dividend? Would you like us to pay a dividend? It's, they're debt free or have really reasonable debt levels, have enough growth capital to continue to grow the business with what they're generating in free cash flow and what they have on the balance sheet. And then they're paying out a percentage of that as a dividend. In this case, it probably would be quite effective to pay off some of that debt instead of paying a dividend. It does seem like a strange move. It's certainly the miss and the lowering guidance probably was the most significant factor to the share price hit. Yeah. But I think investors may have been confused with the dividend paying at that point. I doubt they sold it off 40, 30% because of that. But I think it is a confusing move by a team that, isn't hitting it on all cylinders right now.